The accounting equation is the foundation of all bookkeeping. It shows that everything a business owns, assets, is financed by either what it owes, liabilities, or what the owner invested, owner's capital. Accounting equation formula: assets equals liabilities plus owner's capital. This means the two sides of the equation must always stay in balance. Let's say the owner puts £5,000 of their own money into the business. What happens? The business receives cash, so assets go up by £5,000. At the same time, the owner's investment increases, so capital goes up by £5,000. See, both sides of the equation increased equally. Next, imagine the business buys a computer worth £1,000 but doesn't pay immediately. The business now owns a new asset, the computer, so assets go up by £1,000, but it also owes £1,000 to the supplier. So liabilities go up by the same amount. The equation still balances. Now, the business pays off £500 from a loan. That means cash goes down. So assets decrease by £500. The amount owed also goes down. So liabilities decrease by £500. Again, both sides fall equally, and the balance is maintained. Next, the business earns £2,000 from sales. That means cash increases. Assets go up by £2,000. At the same time, profit increases the owner's share, so capital goes up by £2,000. The business is growing, but the balance still holds true. Finally, the business pays £300 for rent. Cash decreases, so assets go down by £300. That rent is an expense, which reduces profit, so capital goes down by £300. Both sides decrease, and the equation stays equal. So, in every example, something goes up and something else goes down. That's why the accounting equation always stays balanced. Every transaction affects two accounts, but the total always matches. That's the magic of double-entry bookkeeping.